Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. If you want to join our community, finding-value.com, where I dive deeper into all of these topic subjects looking for investment opportunities. Sharing those opportunities with everybody in the community. And we do have a special coupon code going on. Special is in the corner there. Use that on the monthly or yearly membership. We also have a Q&A session, depending on when you're watching this, happening at Saturday, 7 a.m. Mountain Time, which is today. Brian Feroldi says, Warren Buffett talking to Peter Lynch. So this is Peter Lynch. He says, my biggest mistake was that I always sold stocks way too early. In fact, I got a call from Warren Buffett in 1989. My daughter picks up the phone and says, it's Mr. Buffett online. And I pick up the phone and I hear, this is Warren Buffett from Omaha, Nebraska. You know, he talks so fast. And I love your book, One Up on Wall Street. And I want to use a line from it, my year-end report. I have it. I have to have it. Can I please use it? That I said, sure, what's the line? He says, selling your winners and holding your losers is like cutting the flowers and watering the weeds. That one line he picked up in my whole book has been my greatest mistake. It's been my greatest mistake too. I didn't know about these cycles. I didn't know about ratios, investing for many, many years. And what I would do is I would buy stocks and I would sell them way too early. I'd sell them after a few 100% gain. That was my biggest mistake. And if I knew the cycle and I knew ratios and I adopted the strategies I've adopted today, I would be much more comfortable holding longer and holding through the entire cycle. The entire thing with all of this is about identifying cheap, undervalued opportunities and being able to hold through the entire cycle. That is where the most amount of money is made of any strategy. The same thing applies if you read the book Jesse Livermore, Reminiscences of a Stock Operator. He used to trade short term, trade. And then what he realized is that he could make a lot more money trading and investing for the big moves, not the small little moves. So I think really what it comes down to is sizing up big moves and buying great companies to do it with. That's really what it boils down to. And Peter Lynch's mistake, his biggest mistake was selling too early. It was also my biggest mistake. It was not holding long enough, is the way that I call it. The U.S. rig count is now 30 rigs below maintenance levels, equating to 310,000 barrels a day of annualized production declines, or 25% of the full OPEC plus voluntary unwind. This is real, not paper barrels. So there's progress there, and we're more than likely going to see a supply reduction of supply in America for U.S. Oil. TF Metals report says in the fourth turning fashion, people are finally figuring it out. It's all BS. The politicians, the mainstream media, the official government data. All of it is designed to manipulate you and, quote, the markets. Jim Sinclair called in MOPE, Management of Perceptions. He was 100% correct. So a lot of this stuff's coming out now that the data is being manipulated in both directions. It's not just recently. The data's been manipulated for a long time. And I think more and more people are starting to question if the data is correct and how close or how far away is the data. A lot of things are being priced off of the data that gets released. So it's a big deal to make sure that whatever data is being released should be accurate. But it's questionable on the accuracy of the data that's being released for many things. Job numbers, which is aka unemployment, the numbers around inflation and GDP, because if you understate inflation, you're overstating GDP based off of the calculation. Geiger Capital says Trump orders firing of labor statistics commissioner, alleging data manipulation. Says we're going full blown banana republic. Now, here's what's concerning. If the numbers are wrong, if the data is being manipulated and it's wrong, then what is the data supposed to be? Is it manipulated in which direction? Are they overstating it or are they understating it? I'm not exactly sure what's going on here because a lot of the market is trading off of this data being released. So if there is problems with the data, I wonder which way the market will go in the future. Usually, and this is just a general saying, usually if people don't know, it's safer just to sell and get out. So that's what most people do. And that's basically as uncertainty increases, people say, nope, I'm out. Joseph Brown says over a third of the prices in the consumer price index are now just estimates. They're guesses. So we've got labor statistics commissioner saying that they're manipulated, but on over a third of the prices in the CPR are now just estimates. Talking about making the numbers say whatever you want. So if you want a boom, well, we can manufacture a boom, understate inflation, we'll estimate it low, and you overstate GDP. Coming down, unusual whales just in. Trump says job numbers, which showed the biggest drop since COVID, were faked by Biden appointee Erica, whatever her last name is. And he has her order he has ordered her, the Commissioner of Labor Statistics, to be released immediately. Wow. So Peter says Trump is releasing the woman who oversees the calculation of the government's job numbers, accusing her of putting politics above accuracy. But what is Trump actually releasing her for? For overestimating job growth every month he's been president, or for correcting those mistakes today? I have no idea. I'm not sure which direction these numbers are being pushed in. Are they overstating job growth, which I think that's probably what they're doing? And now they're, quote, correcting the mistakes? I don't know. Difficult to say what exactly is going on here. So Tavi says the ISM employment has now dropped to its lowest level since the pandemic recession. Meanwhile, the unemployment rate has already broken above its 3-year moving average, a signal that historically points to further weakness ahead in the labor market. Potential market implication. 2-year yields remain far too disconnected from U.S. fiscal reality and need to move significantly lower, in my view. So if this drops, well, that's not yields, but that's ISM manufacturing employment. If it continues lower, we're more than likely going to see a drop in yields. If yields drop dramatically, that's your slowdown recession. Now, are we in a slowdown recession? I don't know. I mean, which way is this data going? If they're overstating jobs, then yeah, maybe we already are in a recession. Maybe the recession's behind us. Not exactly sure. I don't know what exactly numbers are doctored up here and how bad they doctored those numbers up. I don't know. So yeah, that's kind of where we're at. And if unemployment shoots up like this here, get these these moonshots higher, those are recessions. So that's what you want to see is if unemployment starts to skyrocket. Offered without commentary, Chris Wright, sworn in here, 2/3/2025. Now, I know that they want interest rates to go lower, specifically the 10-year, because they've told us that. The Fed said if rates go up to 4.5%, we want to push them lower. They said that around this time frame. And look what happened to the rig count. Down, 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 down. You think they're in there messing with oil prices? I think they are. I mean, the rig count's dropping. We're probably going to see a loss of production in America. But at the same time, they're trying to offset that with Saudi Arabia oil. So maybe this is all coordinated. I'm not exactly sure. But that's the opposite of drill baby drill. That's rig count drop baby rig count drop. Your assets haven't gone up in value. The money you measure them against has gone down. There's a lot of truth in that one. Now, there are times in history where your assets go up in value. And the way that you know that is through ratios. So you know that your asset is outperforming through a ratio against other asset classes. So you can have everything go up because the measuring stick, the dollar or money, has gone down, but you can see what's outperforming through ratios. That's the only thing that you can use is to take the dollar out of it. So you price an asset versus an asset class against each other using a ratio, and then you see what's outperforming and what's cheap and what's expensive. You avoid the overvaluation areas, you invest in the undervalued areas, and then you just sit and you wait for the conditions to change and for those assets to revalue against each other. And that's really the only way that you can increase purchasing power, because you're not increasing your purchasing power if the dollar goes up and the dollar doesn't and your asset doesn't go up as fast as the dollar's gone down. So what you want to do is, if you're, let's just say you're in gold, and gold is very undervalued, gold goes up in relationship to, say, home prices. Well, if you want to buy a house, that means that your purchasing power of homes increased, which is good. That's what you want. So you can look at these ratios, and during certain market conditions, they fluctuate against each other. So the important thing is understanding what's cheap on a ratio perspective, and then understanding what could potentially cause the ratio to go from cheap to expensive. What market condition is that? And is that market condition coming? Peter Schiff says Scott Bessent criticized Janet Yellen for financing the national debt using mostly short-term maturities. Yet, he's doing the same thing himself. Like his predecessors, he doesn't want to put upward pressure on long-term rates. So he's hoping to keep the same can to his successor. So he's hoping to kick the same can to his successor. So he's releasing everything on the short end. He wants to keep the long end down, which is the 10-year, 30-year. And he's just releasing it just like Janet Yellen did. Because they don't have an option. They have no other option. They don't have another option here. Kobayashi letter says the stablecoin boom. Stablecoins now hold 149 billion in US treasuries and making them the 18th largest external holder. These holdings have risen by 58 billion or 64% since quarter one of 2023. Over the same time period, the market cap of stablecoins has doubled to a record of 240 billion. If the USD-based stablecoin market continues to rise, it will significantly increase demand for US Treasury bills, according to Apollo. In other words, stablecoins may become a significant buyer of US government debt. Crypto may be the answer for lower yields. This is like they're just funneling money through stablecoins to buy treasuries. And then they'll say, oh, well, we've got demand from over here. I think they want to try to get everybody to buy stablecoins and or crypto, because it basically increases demand for their treasuries. Interesting. Trump faked the job data to pump stocks and was mad at the Fed and it was mad at the Fed wouldn't cut. Now they realize, or now they released the real or worse than real job data, and stocks are getting nuked. Fraud is endemic at all levels in American culture and governance. That says Calvin. I don't know. Maybe. Could be the case. Maybe he did that. I have no idea. This was released before Trump firing that person. I don't know if that was done on purpose. I have no idea. But things are getting a little bit weird out here. Copper, China, and emerging markets have always moved together. And we recently saw copper get hit kind of bad, short term. So we'll see. They're all linked together if you look, for the most part. Dorian Rosenzweig, commodities are staging a comeback and investors should take notice. A major boom may be brewing. Here's the full breakdown on the Felder Report podcast. It's a pretty good one. Very similar to my opinions on what's coming. He does talk about oil being an incredibly good investment, which I agree with. The ratio of oil to gold, how ridiculously cheap it is. He talks a little bit about platinum and platinum group metals. So those are the big takeaways, in my opinion. Kobayashi letter says, this is insane. We must have received some massive downward jobs revisions. May's jobs report was revised down by 125,000 from 144 to 19,000. June's jobs report was revised down by 133,000 from 147 to 14. That's 258,000 jobs that have just vanished from the data in 2 months. What is happening here? I don't know. I don't know what's happening here. I know that statistician was fired, whoever it was, but is this done on purpose? How off are these? Is the revision correct? I don't know. Christian Klein says, TA guys, the technical analysis guys, are all telling you it's lights off for silver and gold because the USD strength is back with a vengeance. Yeah, right. The debt bubble is still there and getting worse. Nothing has changed. Buying some silver here for Christian. And you know what? I'm in the camp that silver and gold are going to go higher. I don't care what the short term looks like. It doesn't matter what it looks like. Stay long in this stuff, physical metals specifically, and ride it freaking higher. That's where I'm at. There's no TA that's going to tell me, oh, well, we've got this breakdown. No. I'm not trading, not playing the short term. I think interest rates on the longer term are going to go up. Now, in the short term, if we get a recession, could interest rates go down? Yeah, they could. We could see a move lower if the job numbers are right, but I have no way of telling you if those job numbers are right or not. I have no idea. Today's jobs report was pivotal. There are two ways to get the Fed to cut interest rates: lower inflation, weaker labor market. This is where my question comes into play here. Was it done on purpose? 258,000 jobs were just revised down from the May and June jobs report. Unemployment rose to 4.2% and July missed expectations. They've been highlighting for the last couple of months the labor market has been weakening under the surface. Inflation is clearly not heading to 2% in the near future. And if Trump wants cuts, it will take a weaker job market. Today's headline numbers are shifting attention from inflation to the weakening labor market, which Trump will blame on Powell as he continues to call for rate cuts. Powell will continue to lean on the inflation tariff narrative until the labor market becomes too weak to ignore. Keep watching the labor market. So that's a way that they could get Powell to cut. Just dive bomb the jobs numbers. There are two scenarios after today's data. The U.S. labor market is entering a recession. Something is seriously wrong with the data. I don't know which one it is. I don't know. And this is where the big question mark comes. All of the market is positioning for this to not be there. It makes me think that this is what's happening, that they are releasing weaker labor market to try to get the Fed to cut interest rate. The market has positioned and put bottoms in a lot of inflation sensitive assets. So something's not jiving here. The unemployment rate is rising, and minus 258,000 jobs have seemingly disappeared from the data in 2 months. That's more than the entire population of Scottsdale, Arizona in a single data revision. This comes just 24 hours after the Fed said we have a strong labor market. Something doesn't add up. I agree, something doesn't add up. They said we have a strong labor market. Oh, well, let's just dive bomb the labor market? What's going on here? The Scottish math, okay, I want to go over this real quick. It's going to be a little bit. So, the Scottish mathematician bankrupted France in 1720. He invented paper money and created the first central bank, printed money out of thin air, and made the entire economy collapse overnight. Here's how one man accidentally invented modern banking while stealing from the French. In 1715, France was on the verge of a collapse. Louis the 14th had just died. His wars had drained the treasury. The country owed over 2 billion livres, 75% of GDP. Interest payments alone consumed half of the annual budget. You guys notice any similarities here? The tax system was corrupt and broken. Finance wasn't just broken, it was unfinanceable. Gold and silver were scarce. The monarchy couldn't borrow, the poor were overtaxed, the rich refused to pay. Trade was frozen. Confidence was gone. Paper IOUs like bonds and promissory notes circulated like currency at massive discounts. Into this chaos walked a Scottish gambler named John Law. Who was John Law? A Scottish mathematician and compulsive gambler, exiled from Britain after killing a man in a duel. Charismatic, persuasive, and obsessed with economics. He believed something radical. Money is just credit. Trust can replace gold. France, desperate for answers, gave him a chance. Law's idea, paper money backed by trust, not metal. France's currency was based on gold and silver, but the treasury had neither. So, in 1716, Law proposed a private bank, Banque Generale, that would issue paper money backed by government debt, redeemable in coin theoretically. This was revolutionary and risky. It worked at first. France's economy roared back to life. Paper money made trade easier. Credit flowed, confidence surged. By 1718, the bank was nationalized and renamed Banque Royale. Now it was printing money with royal backing. Law wasn't just a banker anymore, he was a central banker. Then he created the Mississippi Company. Law merged his bank with a massive trading monopoly, the Campagna d'Occident, aka the Mississippi Company. It controlled all French trade in North America: gold, land, slaves, tobacco, fur, everything. He offered the public shares in the company and allowed them to buy shares using his paper money. This was the spark. What followed was pure mania. Shares traded at 500 livres. They hit 1,000, then 5,000, then 10,000. Bitcoin. People sold houses to buy shares. Nobles, peasants, even servants speculated. One street in Paris became the Wall Street of Europe. Law was hailed a financial genius. France was in a state of euphoric delusion. But it was all built on air. The Mississippi Company promised wealth from Louisiana, but the colony was swamp. No gold, no trade. Meanwhile, Law's bank kept printing paper to inflate share prices. More money, more speculation, more hype. Behind the boom, nothing but paper and trust. The crash came fast. In 1720, people tried to cash out, but the bank couldn't redeem notes in coin. It didn't have the gold. Law froze redemptions. Confidence collapsed. Shares fell from 10,000 levers to 1,000 almost overnight. People rioted. Fortunes vanished. The Mississippi bubble had burst. Law fled France in disgrace. By December of 1720, Law was removed from power. He escaped Paris disguised, broke, and hated. The paper currency was scrapped. The company was nationalized. Thousands were ruined. It was the first modern financial bubble in collapse. But his legacy is complicated. John Law failed spectacularly, but he was also a visionary. Pioneered fiat paper currency, central banking, monetary expansion to stimulate growth, equity markets backed by public debt. Everything Wall Street does today, Law did first. The man who brought France back from the brink also nearly broke it forever. That's the paradox of John Law. Not a fraud, not a saint, just a visionary who pushed too far too fast, and in doing so shaped the financial world we live in today. Hope you found this thread grateful or helpful. So that's what I've got for today, guys. That's where I'm going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials at coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.